Before we start this video, do like and subscribe to our channel and not miss on any updates.
So that is the introduction part, what we did. The next part is framework for preparation and presentation of financial statement. Now, framework basically is something that gives the structure. So the role of this framework is twofold. One is, if something is not given in the accounting standards, and you have to interpret few things, you can come and refer to the framework. That's the first thing. Then the framework serves as the basis for preparation of accounting standards. Okay, so what is the purpose of framework? This you can remember for theory purpose. Assist the enterprise in preparation of the financial statement in compliance with accounting standards and dealing with the topics not covered by AS. So if something is not covered by AS, if something is not defined in the AS, you can come to the framework. Assist the ASB, Accounting Standard Board, in task of development and review of accounting standards, not to say accounting standards. Assist Accounting Standard Board in promoting harmonization of regulations, AS, and procedures relating to the preparation of financial statement. So, regulations as in, let us say Schedule 3, they can give recommendations to the ministry how it is to be done and all of those aspects. Helps us auditors in forming an opinion as to whether the financial statements conform to AS. So some definitions, you can pick it up from framework and see whether true and fair view are there. And users can interpret financial statements used on basis the framework. Okay. The framework applies to general purpose financial statements which are prepared for external user. General purpose means a common financial statements which is prepared for the multiple users. Okay, if it is a special purpose financial statement, let's say preparing something for projected financial statements and all of that, those are not covered by the framework. The framework defines users of financial statements or indicates users of financial statements as investors, the shareholders who have given the money, lenders, loan given, government, public, employees, customers, and suppliers. These are the users of financial statements, and the framework is used to prepare financial statements for these users. Okay, now if accounting standard says something else and framework says something else, then accounting standard will prevail over the framework. There are some cases, and no need to remember these, but there are some cases where definitions in framework is different from the definition in the accounting standard. So what will prevail? Accounting standard will prevail, okay, as compared to the framework. Now, coming to the first part covered by the framework, components of financial statement. Now, if you see, Schedule 3 already prescribes the financial statement format. Companies Act already tells us what are the components of financial statement. But again, this gives us a general guidance of what is included in financial statements, what should be the qualitative characteristics of financial statement. So that is what is given in this particular framework. When it comes to components of financial statement, you have balance sheet, profit and loss, cash flow, notes, and other explanatory statement. This is again only for MCQ. All of us know what are included in each one of this. They are required to show a true and fair view of the performance and financial position and cash flow of an enterprise. So financial statement should give a true and fair view of what? Performance. Performance is given by P&L. Financial position is given by balance sheet. Cash flow is given by cash flow. So performance, P&L, financial position, balance sheet, cash flow. Okay. Now, what should be the characteristics of financial statement? They should be understandable. Understandable means users should be able to understand. They have to be relevant. It has to be relevant for the users. Relevant means the information that you give, that has to be relevant. You should not be giving irrelevant, unnecessary information that is not relevant for the users of the financial statement. For example, let us say Reliance Industries. Reliance Industries turnover is 250,000 crores. In crores, there is printing and stationery expense of 2,000, just for example. This is not relevant. Okay, so that is how we have to see what is relevant to the users of the financial statements, and that is how we have to give the information. They have to be reliable. The users must be able to rely on the financial statements, the information given in the financial statements to take decisions. And lastly, they must be comparable. Comparable means you must be able to compare the financial statements of one entity with another entity or within the same entity on a year-to-year basis. So characteristics, they should be URRC. Understandable, relevant, reliable, comparable. Understandable, relevant, reliable, comparable. Components, balance sheet, P&L, cash flow, notes. P&L shows the performance, balance sheet shows the financial position. Then we talk about fundamental accounting assumptions. This is as given by Accounting Standard 1. Going concern, consistency and accrual. Accounting policy can be changed. We have already discussed this as well. Then comes elements of financial statement. What are the elements of financial statement? Elements of financial statements are basically balance sheet elements, P&L elements. Balance sheet elements are assets, liabilities, and equity. Assets is equal to liability plus equity. This is the accounting equation. Then you have income and expense. Income minus expense gives you the profit. What is an asset? Asset is a resource controlled by the enterprise as a result of past event from which future economic benefits are expected. Resource controlled by the enterprise as a result of past events from which future economic benefits are expected. What is liability? We have seen this in AS 29 as well. Present obligation arising from past event, settlement of which is expected to result in outflow of resource embodying economic benefits. What is equity? Residual interest in the asset of an enterprise after deducting all liabilities is called equity. Can be tested for MCQ. Income, increase in economic benefits during the accounting period from inflow or enhancement of asset or decrease in liability that result in increase in equity. Now this is a very typical definition. We generally know what is income, but what does income give us? Income results in increase. Income results in increase in economic benefits. Increase in economic benefits from inflows. You have received something, asset has increased, liability has decreased. Ultimately, income will increase the equity. Income will increase the equity, and expenses, just opposite, will decrease the equity. Okay. This we have already seen. Then framework also talks about how can we measure different elements, okay, especially when it comes to the assets and liabilities. So elements can be measured either at historical cost. Let's say fixed asset. Fixed asset can be measured at historical cost. Fixed asset can be measured at historical cost, that is the purchase price. It can be measured at current cost, but see, this is just the definition. AS16 also tells, AS10 also tells us that we can measure the assets at current cost, something like your fair value revaluation model. Cash that would have to be paid if the same or an equivalent asset was acquired currently. Then we have realizable cost, net realizable value, what we talk about. Cash currently realizable on sale of asset in a disposal. So what is the difference? Current cost means amount that I need to pay if I have to acquire the asset. Realizable means the amount that I will get if I sell the asset. So current cost is from buying perspective. Realizable cost is from selling perspective. Then we have present value. That is, the present value is basically what is the amount that you will receive today based on the future cash flows. Okay, so obtaining present value of future cash flow. What is the present value of future cash flow? The process is called discounting. Now, present value is the amount one has to invest on current date to have an amount after some particular years. So present value is basically future value divided by 1 plus r to the power of n. This we have already seen. These things we have already discussed: understandability, relevance, reliability, comparability. Please ensure a couple of points from this part you are able to write and understand. This sometimes is tested in MCQs and also as a part of your regular thing. Constraints on relevant and reliable information. Now, what is a constraint? Constraint basically means something which is not allowing us to give full information. Okay. Now, if, for example, I want to give all information which is reliable, if I want to give all information which is reliable, it will take me 6 months. Now, if I report something after 6 months in today's era, is it even useful? It is not useful. So, if there is a delay in reporting of information, then the information loses its relevance. So, I have to give it on a timely basis. Now, if I'm trying to give it on a timely basis, I may not be able to give all the information. If reporting is done without obtaining all information, it may not be reliable. So, there is a constraint. I have to give relevant information. For giving I have to give reliable and relevant information. For giving reliable information, I need a lot of time. If I take a lot of time, the information will not be relevant. Okay. So this is one constraint. The other constraint is balance between benefit and cost. See, if I have to gather some information, process that information, and if I have to give it to the users of the financial statement, I'll incur some cost. If I'm incurring some cost, the benefit should be more than the cost. Benefit should be more than the cost. If huge amount of cost is incurred to derive a benefit, then it is of no use. So that is why you would see subsequently when you go to CA final, there are some practical exemptions kind of thing which are given so that entity doesn't need to spend huge amount of money to extract the information. So constraints, timeliness. If I give it late, it is not relevant. If I give it faster, all information may not be there. And benefit and cost, there has to be a match. Financial statements, as we said, should give a true and fair view of the performance and financial position and the cash flow of the enterprise. Okay. Then this all of us have been doing basically the capital part of the business. Okay. Basically, opening capital plus profit minus losses plus capital introduced minus drawings gives me closing capital. Okay. Now, from this equation, if at all a question comes in the examination, you should be able to calculate what is the profit or loss made during the year. How? Any missing number. They may give you opening capital, they may give you profit or losses, they may give you drawings, they may give you closing capital. You can find this number, which is the balancing figure. Okay. Now let's look at this question. Preparation of financial statement assuming going concern and assuming not going concern. Okay. So if it is going concern basis, then you will carry the amounts at historical cost only. If it is not a going concern, you will calculate or you will show it at a realizable value. So what is given? Capital is given, P&L balance is given, loan, trade payables, assets, stock, trade receivable, deferred cost, and bank. Okay, all of these are given. The remaining life, this is as on 31st March of year 1. The remaining life of fixed asset is 5 years. Pattern of use of the asset is even. The net realizable value of the fixed asset is on 31st March is 60,000. They're saying 5 years useful life remaining. If I follow the going concern assumption, I will provide depreciation on this and I will do the calculation. If it is not a going concern, then I will show the asset at realizable value, which is 60,000. Traders purchases and sales amounted to 4 lakhs and 4.5 lakhs. So that doesn't change. Cost and net realizable value of stock on 31st March were 32,000 and 40,000 respectively. So if I'm following the going concern, stock is 32,000. If I'm following non-going concern, stock is 40,000. Sir, how can we increase the value of stock? See, the company is no longer a going concern. Means we will sell off the assets and liability. So we'll show everything at net realizable value. Expenses for the year amounted to 14,900. It doesn't change. Deferred cost is to be amortized equally over 4 years. So this deferred cost of 10,000 divided by 4, you should amortize it equally over 4 years. So if it is a going concern, expense will be 2,500. If it is not a going concern, this deferred cost does not make sense to me and that 10,000 will be written off. Debtors on 31st March is 25,000, out of which 2,000 is doubtful. Collection of another 4,000 depends on successful reinstallation of certain product supplied to the customer. 25,000 is the trade receivable. 2,000 is doubtful. 2,000 is doubtful. So we'll make provision for doubtful. Another 4,000 depends on reinstallation of product. If I'm closing my business, I'll not be able to reinstall the product. So this 4,000 also will be lost. Closing trade payable is 12,000, likely to be settled at a 5% discount, and cash balance is 37,100. There is an early repayment penalty for the loan 2,500. So if I am closing down the business, I have to pay these charges of 2,500. How do we prepare the P&L? Sales will remain the same. Closing stock higher based on NRV when it is not a going concern. Okay, then opening stock will remain same, purchases will remain same, expenses will remain same. Depreciation, the depreciation part will change. If it is going concern, 13,000. If it is not a going concern, it is coming down from 65,000 to 60,000. So only 5,000. Deferred cost not going concern, 2,500. If you are not a going concern, fully written off. Provision for bad debt 2,000 if going concern, another 4,000 if not a going concern. Interest will remain the same for the year. Penalty, if it is not a going concern, we have to pay penalty of 2,500. Then trade payable, if you, what they've said, which is likely to be settled at 5% discount. So if you are settling it immediately, 5% discount. So that comes only if it is a not going concern. Okay. Now from this, you will get the profit. Then coming to the balance sheet, fixed asset, if going concern, 52,000 based on depreciation, realizable value. Stock, realizable value. Trade receivable, 25,000 minus provision of 6,000. Deferred cost, 0 because it will no longer be there. Cash in bank remains the same. Capital, 60. P&L, depending on whether you have earned 16,100 or 18,700. Right? Then interest payable will remain the same. Loan 35,000, here higher amount because of penalty. Trade payable, full value, discounted value. This is not going concern, this is a going concern. Okay, this is a simple thing. If at all a question comes in the examination, we should be able to score full marks. Okay, this you can do it on your own. There is nothing complicated as far as the thing is concerned. Just that, take the opening capital, capital introduced, any income that you have received, settlement, wages paid, rent outstanding, and final drawings, you will get to the closing equity. Okay, so here what they want us to do is step by step. So for example, opening capital equity is 3 lakhs, asset minus liabilities. Introduce capital 20,000. This will increase the asset, no change in liability, it becomes 320. Income from investment, increase the asset, no change in liability, 328. Settlement of liability will reduce my asset, will also reduce my liability and equity. Why did equity increase? Because we settled with only 30,000. Wages paid, reduce my asset, no change in liability, overall equity reduces. Rent outstanding, it will increase my liability, it will reduce my equity. Drawings of 4,000, reduce asset, reduce equity. Right? So this concludes the framework of the financial statement. But again, not really great importance if you ask me for the examination, but here and there they keep on testing theory. All right. So today we'll conclude here the session. Tomorrow we don't have a session. Day after tomorrow we'll do the applicability of accounting standards followed by buyback of shares, and then one more session we'll take to discuss the MCQs and overall conclusion of the session. Okay. Any questions? Yeah. Happy New Year to each one of you. Thank you.